In this video, we'll go through dividend versus growth investing to uncover which one is better to invest in. I also backtested a few growth and dividend portfolios to get some real-life data that I'll share with you as well. If you're anything like me though, then the simple response to this is, who cares? I'm just going to continue buying my index fund ETFs and move on with my life. In that case, don't worry, because with something like VTI and VOO, you're investing in both growth and dividend stocks. Hey, I'm Jarrad, and on this channel, we like to talk about personal finance, investing, and financial independence. Please do me a huge favor and Hulk smash that thumbs up button, not just for me, but do it for my dog Molly as well. I'll make a bold statement in some people's eyes right off the rip before we get into it. If you're under the age of 45 or still in the wealth accumulation phase of life, then focusing on building up a large dividend portfolio could hurt more than it helps. In some cases, I could even argue that you're better off avoiding dividend stocks until you're retired and not working any longer. To explain why that is, we first need to understand why a business would even bother paying out a dividend in the first place. Companies don't just pay dividends for fun. I know we like to pretend like they do it out of the goodness of their hearts, but they could care less about making us feel all warm and fuzzy inside through regular dividend payouts. They do it because they've come to a point in their business life cycle where they have too much cash on hand that they don't have anything more productive to use it for. Because of that, they can do one of two things with that extra cash that'll return some value back to shareholders. The first thing they can do is buy back shares, which will automatically increase the stock price and benefit you as a shareholder of that stock because, you know, when there's less available shares to buy, the shares that are left become a lot more valuable. Or number two, pay out a one-time or ongoing dividend, which technically decreases the share price by that amount, but will at least put cash in the pockets of shareholders. Generally, when a company pays out a recurring dividend, they're signaling to the world that their financials and projected income are healthy enough to commit to that scheduled payout. When you receive a dividend payout from a stock that you own, that's the company's way of saying, here you go, take this money, do something with it because we don't have any better use for it. You could probably find a better place to put it that can get you a higher return on investment than we can. It's not necessarily a bad thing that the company can't find a better way to use that money to grow the business. They might just generate so much money that they don't know what to do with it all. So instead of investing it into something that might not be worth the payoff, they reward their shareholders through a dividend payout. On the other hand, a growth company is focused on one thing and one thing only: growing. And to do that, they need money. Lots and lots of money. This is why they'll never pay out a dividend or even pay out a very, very tiny dividend. Insert Apple with their cute little baby dividend of 0.59%, even though they have more cash on hand than a ton of countries and continue to grow at astronomical rates. If you were a shareholder of a company like Tesla, then the last thing that you'd want them to do right now is pay you a dividend. That's because the more money that comes off their balance sheet to pay shareholders in the form of a dividend, the less that they have on hand to pump back into the business to grow it. Not only will growth companies like Tesla not pay out a dividend to preserve cash, but they'll also take on debt or even issue more stock, which in turn will dilute their current shareholders to gain access to more money to hopefully grow the business. Fun fact, since 2010, Tesla has more than doubled their shares outstanding from 400 million shares to 1.1 billion shares. Ouch. Diluting current shareholders by issuing more stock isn't necessarily a bad thing as long as they use that additional cash in a productive way that will eventually pay off for the owners of their stock. Having extra cash on hand to be deployed within the business is like fuel for a rocket ship if used properly. In turn, shareholders of these growth stocks are expecting to be paid back through an increase in price per share of the stock as opposed to through a regular dividend payout. The downside of this is because a growth company is sprinting full speed 24/7, there's a possibility that they'll burn out before even getting to the finish line. If they don't completely burn out, then the expected growth might never be achieved, which will eventually tank the stock price. Let me be clear about the whole stock price growing thing. I am by no means trying to imply that a company that pays a dividend won't grow its stock price. I'd hope it does, or else we're going to have some real problems. But what I am suggesting is that as a whole, dividend stocks will most likely underperform growth stocks over the long term. I ran a backtest with a high dividend yield ETF, growth ETF, and a total stock market ETF, each investing $10,000. The returns give you an idea of how things have played out so far, with all dividends within each portfolio being reinvested. The high dividend yield ETF brought up the rear with an 8.4% average return and a portfolio balance of a little over $33,000. The growth ETF had an annual return of 13.4% with the portfolio balance of a little over $64,000. And the total stock market ETF saw an average annual return of about 10.6% with the portfolio balance of $44,800. The high dividend yield portfolio lagged behind the growth portfolio by 5% and $31,000. It even lagged behind a total stock market ETF by 2.2% and almost $12,000. Keep in mind that we've been in a bull market over the past 12 or 13 years, which has definitely benefited the growth stocks more than the dividend stocks. When the market eventually turns, whenever that is, growth stocks are going to get destroyed, which could easily reduce their average return down closer to those higher dividend paying stocks. But the good news for growth stocks is that if the past 30 years are any indication of the future, down years don't happen very often. Yes, they happen, and when they do, it is ugly. But in the grand scheme of things, it's a small blip in the radar. This alone isn't the only reason to invest in growth stocks or dividend stocks, though. The answer to that question has more to do with where you're at within your investing life cycle. High dividend paying stocks are great for people looking for immediate income. Growth stocks paying very little to zero in dividends are good for people who are looking to grow their investments at a faster rate and don't need income from their investments within the next 5 to 10 years. If you're young and in the accumulation phase of investing, so roughly under the age of, we'll say 40 to 45, then building a large portfolio of high dividend paying stocks is an inferior way of investing your money. Why trade the lower potential returns from dividend paying stocks to get immediate income that you don't need because you already have a job paying you an income today, when in reality, you could be focusing more on growth with higher potential returns to build up a larger chunk of money? It just doesn't make mathematical sense for someone who is younger, nowhere near retirement, and doesn't need to preserve their investments. One thing a dividend investor might say is that since they can reinvest their dividends, they can immediately buy more shares of those dividend paying stocks to continue to increase their position, which will increase their dividend payments. That's a fair enough response, but that doesn't change the fact that the stocks that you buy will continue to underperform growth stocks. You're better off just buying more growth-oriented stocks when you don't need the income to grow your portfolio larger than the dividend portfolio. Then once you need the income, you can buy into those high dividend paying stocks with even more money than if you had stayed invested in the high dividend paying stocks from the very beginning. In the back-tested example that I went over a minute ago, starting with a growth portfolio, then moving to a dividend portfolio would have given you $28,000 more to buy more high dividend paying stocks later down the line. I think psychologically, dividends are very appealing to young investors because of the passive income aspect of them. Yes, it's possible to build up a big enough dividend portfolio to where it could eventually replace the monthly income from your career. To be honest, it sounded so appealing that it led me down the path of doing more research to figure out if it was the route that I wanted to be taking with my investment portfolio. I ultimately came to the conclusion that I'm too young to be messing with that path of investing at this point in time. Even though some of them are more optimal than others at different ages and life stages, I could care less if you invest in high dividend stocks, growth stocks, or total stock market ETFs. What I care about more is that you're actually investing consistently with some sort of process in place. If building a dividend portfolio does that for you, then by all means, go for it. I know a lot of smart people who love dividend investing. Two other YouTube creators who I'm good friends with, Brad Finn and JJ Buckner, are both big on dividend investing. Yes, they also invest heavily into index funds like me, but they also enjoy building dividend portfolios as well. I'll have links to check their channels out in the description if you're interested. I actually think that JJ is currently in the process of building some sort of a dividend tracker, so go check him out if you're interested to learn more about that. Either way, I'll be over here on the sidelines rooting for you to continue pumping money into the stock market no matter what your investment method of choice is. Watch these financial independence and investing videos to your left to next. Make sure to Hulk smash that thumbs up button before you go. Check out the description for more resources and playlists to help out with all of your personal finance and investing needs. I'll see you in the next one, friends. Done.